February 2026. While the world was watching interest rates, the architect quietly changed the blueprint. The dollar trap hasn't just closed, it's being dismantled from the inside, and the first casualty has already fallen. For decades, as we explored in our previous analysis, the world was held captive by the dollar trap, a system of structural dependencies in trade, debt, and energy that made escape feel impossible. But today, the story has changed. We are no longer talking about a trap we want to leave. We are talking about a system that is being intentionally dismantled from the inside. At the center of this seismic shift is one name: Kevin Warsh. His nomination as chairman of the Federal Reserve in early 2026 is not just another political appointment. It is the definitive signal of a new monetary regime. Warsh is a man who understands crisis better than anyone, having sat at the table during the 2008 collapse. But his return marks a radical departure from the era of Jerome Powell. Warsh represents what insiders call the doctrine of institutional neutrality. His mission? To end the Fed's role as the world's global stabilizer and return it to a narrow, nationalistic mandate. The markets felt the shockwave instantly. Gold prices, which had been climbing on fears of inflation, suffered a violent 9% reversal as the prospect of a Warsh-led Fed signaled a massive withdrawal of liquidity. This is the Iron Dollar strategy. By shrinking the Fed's balance sheet and focusing strictly on price stability, Warsh is effectively telling the rest of the world that the era of easy dollar liquidity is over. The Fed is no longer a general-purpose agency of global government. It is becoming a weapon of domestic productivity. Welcome to the new mechanics of power. Subscribe to follow the shift as it unfolds, one piece of reality at a time. To understand the first real-world casualty of this new doctrine, we must look at Japan. In February 2026, the Japanese yen became the first major currency to hit the wall of the Warsh era. Japan has spent 70 years as the most loyal pillar of the U.S. financial system, holding trillions in American debt. But loyalty has no value in a regime of fragmentation. As the dollar hardened, the yen began a vertical collapse. The internal conflict in Tokyo reached a breaking point. Finance Minister Katayama demanded massive interventions to save the currency, while Prime Minister Sanai Takaichi saw the weak yen as a major opportunity for Japanese exports to bypass American tariffs. The resulting political chaos led to Takaichi's resignation and the shortest snap election campaign in Japan's post-war history. When the Bank of Japan was forced to burn $50 billion in a single week just to stop the bleeding, the world received its warning. If the most faithful ally of the United States can be left to drown in the currency markets, no one is safe. The dollar trap is no longer just a cage for your trade. It is a weight that will drag you under as the architect pulls the plug on global liquidity. But while the traditional allies of the West are struggling to breathe, other nations are implementing a different blueprint for survival. This is where we see the rise of the sovereign hubs, with Turkey serving as the primary case study. To understand Turkey's position in 2026, you have to look back a full century to 1927. The legacy of that era was an obsession with total sovereignty, the idea that a nation is only truly free if it controls its own physical reality. Today, we are seeing the final execution of that century-long vision. While the world fights over digital zeros and paper debt, Turkey is securing its physical gates. The Canal Istanbul project is not just a piece of infrastructure. It is a geopolitical declaration of independence. For nearly 90 years, the 1936 Montreux Convention has limited Turkey's ability to fully monetize and control the Bosphorus. By building a sovereign bypass, Ankara is effectively reclaiming the gate between the East and the West. This is an economy built on geography, energy, and steel, tangible assets that a Federal Reserve nomination cannot devalue. When you combine this with the fact that the Turkish people hold an estimated $500 billion in gold under the pillow, you see the construction of a fortress. It is the concept of mizan, the balance. It is a hedge against the fragmentation of the dollar system. They aren't trying to replace the dollar with another paper currency. They are anchoring their future in assets they can touch, see, and defend. This leads us to the ultimate projection for the end of the dollar era. It will not be a sudden, cinematic collapse. Instead, we are entering the era of the great fragmentation. The unified global market is breaking into three distinct paths. Path 1 is the path of the indebted. This is for the nations that cannot escape the iron dollar. They will face high interest rates, suppressed growth, and the slow liquidation of their national assets to satisfy a Federal Reserve that no longer cares about their stability. For them, the trap has become a tomb. Path 2 is the path of the digital panopticon. This is the solution being offered to the remaining Western allies: central bank digital currencies, programmable money, a system where the dollar becomes a digital tool of total surveillance. It offers the illusion of safety and continued trade, but at the cost of every last shred of financial privacy and national autonomy. Path 3 is the path of tangibility. This is the road taken by the emerging hubs of the East and the Middle Corridor. It is a world where trade is settled in gold, oil, and physical commodities. It is a return to a pre-1914 style of sovereign power, where the strength of a nation is measured by its gold reserves and its control over trade routes, not its access to a central bank's printing press. We are living through the end of the 1971 monetary system. The nomination of Kevin Warsh, the crisis in Japan, and the rise of physical fortresses like the Canal Istanbul are all pieces of the same puzzle. The architect has decided that the global dollar system is no longer serving the interests of the center. The withdrawal of liquidity is the catalyst for a world that will be more regional, more volatile, and more divided. The projection for the next decade is clear. The dollar will not disappear, but it will cease to be a global public good. It will become a private tool of a fragmented empire. In this new world, the only true hedge against the collapse of systemic trust is sovereignty. Don't watch the headlines about interest rate cuts or inflation targets. Watch the movement of gold. Watch the construction of new trade canals. Watch the leaders who are dismantling their old political networks to prepare for a world without a safety net. The future does not belong to the ones who have the most debt, but to the ones who control the physical gates of the world. The transition is happening in real time. The era of the single global monopoly is over, and the era of the fortress has begun. The question is no longer whether the dollar trap will break, but who will be standing in the ruins when the dust finally settles.